Hello, this is a Modern Investing with Sasha. It's a program which is featured here every Wednesday. And my name is Sasha Starr, and I would like to introduce my guests for today. My co host, Peter Bennett, former
Hi.
professional from Wall Street. How are you, Peter?
Okay. I hope everything's
Good.
well.
And founder of the network, Nick Poliveda. Welcome to the show, Nick.
Hello, Sasha.
Hello. So, I would like to start with something which just came across my mind while I was watching different investment advisors, their website, and what they're suggesting. I found one very interesting, something called Monday Morning Millionaire, which suggests that the investment approach, which he's teaching or advising on is actually very simple one. You can teach it to 4 years, fourth grade students, which is index investing. You do just nothing, just buy index fund, one of ETFs, and that's it. And you will beat 95% of professional money managers. Peter, what do you think about this strategy?
Well, I have two thoughts. One, for many investors, the average investor, he's right because study after study, generally shows over most time periods for sure that the indexes outperform mutual funds and brokerage recommendations. I mean, the thing is, most mutual funds have large fees. If you're talking, you have to be very conscious of your fees. If you're paying 1% a year, that adds up to a lot compounded over 5, 10, 20 years. So I think he's right. I wouldn't do it because I think I can outperform the indexes and I've done very well. And I think you can too, based on our show. And, I don't have, but, and I'm not opposed to it. I've used indexes at time also.
Yeah. So this is actually sound approach. I think we never discussed that on our shows, but of course it's a quite old strategy. It's a lot of proponents. Uh, I think there are more proponents than people who practice that because a lot of people they are convinced that they can outperform the
That's
index.
true. A lot
Uh,
of people have.
I think most of the people probably will be disappointed with their performance because it's very difficult to beat the index funds, especially when we are coming into the bear market territory.
Right, exactly. I was going to say
Especially
it's going to
painful.
be if you do well in a market that's going up, but you underperform, it still might feel like, oh, I'm doing great. But when the market starts going down, if it starts going down, and I'm going to make some points about that, but if it's a bear market, all of a sudden it's like I lost money. Maybe I'm not outperforming, or either way, I'm not too happy because I'm losing money. And
Yes,
this is
that's
something that people have not experienced this really a serious bear market often at all in the last 20 and 30 years, mainly because the Fed has been lowering interest rates down to near zero to stimulate a market that wouldn't be where it is today, except for the fact that they've been lowering rates so much. But now the party's over in terms of once they get to zero, there's no more stimulation they could do. They can go negative like Japan, but you can't do much with that, to stimulate the economy, as Japan found out. And also, uh, so and now they're under a lot of pressure to raise rates, which is something we haven't seen a lot. But
we'll see it in an hour. What's
well,
happening?
yes, I was going to mention that, and but you know what? This is what I would say. First of all, I don't care if the Fed raises rates a half a point or three quarters, because it's all part of the big picture. They're going to have to raise rates a lot, and if they just like last time when they raised a quarter, and I said they should have done a half, but if they do a half now, they'll just have to do more later. The only question nobody knows in the market is how high they have to go to control inflation. But let me just read. I try to do it like rote, and I just make my points off of bullet points I make, and maybe refer to a few articles. But this week there was so much in the articles that I thought were worth mentioning that I pull out. I read an inordinate amount about investing and spend a lot of time on it. So one, Morgan Stanley investment bank strategists forecasts a sharp downturn in the market. Now he's one of the most bearish, I'll admit, but I agree with him. I think we're in trouble here. He's saying today, I looked at it, was at 4181, the S&P. He's expecting as low as 3460, where there's support, which is almost 20% below today.
Oh, yeah.
And he's saying the minimum downside is 3,800, which is, depending on, let's say it's 10, 12, 15%, depending on the day. So he's saying it's going down. We just don't know how far. And Morgan Stanley itself was citing deglobalization, decarbonization, and a labor crunch. It makes perfect sense. These are not normal conditions. Another article said the Fed is signaling a very aggressive monetary tightening. The market bulls don't believe that the Fed will actually implement it. The Fed has to restore its credibility, and it will walk the walk. The S&P 500 is an unfolding bear market. So nobody's believing that the Fed is going to do this. By the way, I think it was in December that people were forecasting like a 0.8% Fed funds rate. Now people are talking about at the end of the year 2.75 or 3. They may have to go much beyond that. Nobody knows again, because we've never been in quite the situation. But the Fed can only do so much to control inflation and energy. And every time they raise rates, obviously it's going to push us towards recession, which is going to hurt a lot of companies, depending on the sector. This one says a 6% funds rate. Some investors say the risk is there. It says in this article, researchers at Deutsche Bank wrote that the Fed funds rate is moving into the 5% to 6% range in order to do a sufficient job, which interestingly matches the two Larrys, Larry Summers and Larry Kudlow, who I've been talking about, said it probably has to get to 6% just to control inflation. Now that again is short term, but I don't think it's personally going to get that high, but I think it's going to be somewhere in the middle. They said the 10-year is currently, they said around 2.8%, but today it's already 3% and could peak around 4.5% to 5%. In which case, I made a mistake on my investments, which we'll discuss later, because I bought some bonds, but long-term bonds. But it says also in this article, government bonds experienced one of the worst quarters in total return since the Civil War. So if you're a bond investor, you have to have guts to go in there now. Maybe you're just saying, you know what, I'm going to wait. So, supply and demand in bonds too. And maybe a lot of people are saying, we'll wait. Then there's also this article, traders are pricing in a 46% chance of the Fed's funds rates hitting 2.75 to 3%. Okay, but it could be a lot higher again. It's affecting mortgage rates now. So, and then it says, and one of the key points, and it's always been for 6 months now, way before the market, I was talking about inflation and energy, but this one is about energy, and it says JP Morgan analysts noted that a prevailing level of basically prevailing levels of global spending on energy are way too low, and that there's a lag. It's 20% short, basically, of what needs to be done. So they are saying that they're going to require $140 billion on average more for CapEx, and this is what I've been saying for a year, maybe. USAC said that there's 40% less in CapEx being invested. Moody's said last week 57% needs to be more invested. The oil companies are not going to turn around and energy companies are not going to turn around and all of a sudden say, oh, let's put all our money into this CapEx now, because we're in a different environment. First of all, if you read the articles, even this week I saw, they're saying we can't get people. Our supply chains are short, so we can't get parts necessarily to build quickly. The Biden administration is extremely hostile to energy. They're doing almost everything they can, and then they window dress it a little, but I won't go into the specifics, but all over the place, they're trying to get energy down. And if their strategy is to force energy prices up so that we switch to solar and everything, then that might be it, but it's still going up. So this last article I thought it was just well written. It says, warning signs of a lost decade, focus on dividends. And that's what we love to do on the show. So it said the PE multiple expansion since the 80s to 2010 was largely driven by falling interest rates, which is what I just said too. Interest rates have now already hit zero and now seem to be rebounding. Stocks may be facing a lost decade where stock prices remain volatile. Dividends will play an important part in generating returns. Historically, periods of high volatility, during these periods, dividends make up a much higher percentage of total returns. So it's more important than ever to have income generation, because that way, if the stock goes down, you're still making money, and it also is very defensive because if the stock goes down, the dividend goes up unless they drop.
Absolutely. And if you take high yield dividend stocks, they're all doing extremely well, even in this quite a down market. I would call it that way. I wouldn't call it a bear market, although some people would agree that it is nothing else but a bear market right now. However, I noticed interesting since the company earnings are doing quite well. There are some disappointments here and there, but generally speaking, they're quite like yesterday. One of the stocks that I have is AMD, Advanced Micro Devices. They had spectacular earnings announced yesterday. Stock went way much higher on the opening, then it went down. Now it's up again. So it doesn't matter. But what still I was selling, for example, today when stock shot up, I sold the defensive covered calls on the stock. And guess what? When the stock went down from 97, approximately, it went down to 91. I bought them back at the profit. And now it's hovering around 94, 95. Now I'm thinking to sell them again. So
it's always good to be the casino. When you're selling puts and calls, I mean,
absolutely.
You're the casino, so you have a much higher chance of winning, without a doubt. And it's a nice way to generate income, just like dividends.
Actually, if you think about it, you're in a situation where you cannot lose. The only thing, you will not win as much as, for example, if AMD would shoot up, say, to $125, which was much higher while ago, you will leave a lot of it on the table. However, not necessarily so. First of all, the stock doesn't go straight up. It goes up maybe a day or two, three, then it goes down and corrects itself. And because time is on your side, so there will be always an opportunity either to close your position on covered calls or rewrite them to close the position and sell.
Yeah, you could keep on writing it for pretty much ever as long as the company survives, which is true. But again, you could lose a lot in the medium to short run if the market keeps tanking. I just moved. I had been selling a lot of covered calls. I did it on Microsoft, did very well over the years. KLAC, NVIDIA, on your recommendation earlier, a year or two ago, did very well with selling all puts. But now I just said, I don't need the risk, and I don't like the way it's going in the market, because even the big quality tech companies, Google, Amazon, Microsoft, the prices are down so low and they're going lower. And if you look at the analyst forecast, like Amazon, it might be like 3,400 or 4,000, and the stock's at 2,600 heading to 2,400. Well, the analysts are behind the curve here, but because the macro picture, but also because of PE compression. And so a company might make more in the next few years, but if they don't have a dividend to support it, particularly where they can put that earnings back into dividends, they could, of course, buy back shares. But you could lose a lot on PE compression, because if rates were 4% or 5%, or wherever they're going, that could really, really drop the market, where every stock is just valued differently.
So although their earnings are quite spectacular at most of the companies, like for example AMD, okay, they got spectacular earnings yesterday, but the valuation of these earnings with higher interest rates will be very different from against the low
exactly.
So
And that's why I dumped. Right, exactly, and that's why I dumped Microsoft. And now I only have one options position where I sold puts. And it's Amazon, because out of all these, I didn't even want Microsoft, because there's a big correlation between Microsoft and Amazon, in my opinion, because their AWS is Amazon's main,
Absolutely.
driver, even though they control 40% of U.S. sales over the internet, which is phenomenal. But I don't worry about Amazon particularly because people have said, oh, they had a terrible report. Their cash flows weren't as good and everything. Well, they lost money on a subsidiary, but also the other thing is you can't look at these companies, even at Google and Microsoft, which are massive now, because they're reinvesting so much. So they're building their businesses and they're creating new businesses. And, but they have the ability to say, you know what, let's just take some of the profits or let's buy back our shares more, or they have lots of options. They're not crazy. The reason they're reinvesting is they keep getting better and better, So that's the one company they say, buy what you love. Buffett said it and other people, or I think it was Peter Lynch. I'm not sure. But so, that was the one I held, but and so I sold the 4,500 put, which I covered a bit on 2 years out or a year and a half out. And you know what? But I'll keep doing that. And in a year and a half, if it's down, I'll just do it and do it and do it. And I keep the money from the put. And eventually, in 5 years, 10 years, whatever, I'm pretty sure it'll be a lot higher.
Mm-hmm. Nick, how you navigate the markets these days?
Well, so far it's all good, but like I said, I went all to cash for the most part, except I kept the pipelines. The pipelines keep pushing up because they pay dividends. So I'm still staying with Antero Midstream, Enbridge, USA Compression Partners. So the thing is, I haven't had any real problems. But the real thing I'm looking at is what the Fed is going to do. And since I said, well, we got a clip on the Federal Reserve. It's not very long. It's like a little bit of a minute. We interviewed the Federal Reserve, and let's go take a look and see what they have to say.
Right. Well, you talk about your president, which is the president of this particular Federal Reserve Bank. There are 11 other presidents, if you will. And the Federal Reserve is focused on monetary policy, which is what we're talking about. But there's also another president. It's the president of the United States.
Absolutely.
And there's also something called the
fiscal
Congress,
policy,
which focuses
which you
on
would care about
policy.
in your former life,
which is taxing and spending or whatever. Can you talk a little bit about how what you do kind of interrelates to that?
Sure.
Because I know you want to be independent, and that's very important.
Right.
Yeah. So what we're doing, right? When we need to try to have a view on how fast is the economy going to grow? What's going to happen over the next 2 to 3 years? And so to do that, we have to have a view about what we think the policies of the executive branch are going to be. What kind of tax policy is there going to be? What's going to get through Congress?
And the Congress.
And the Congress. What's realistic? What's going to happen?
Yeah, that was actually Anna Paulson, who's the senior vice president at the Federal Reserve. And the reason I'm following that, and I decided to wait, because the effect of bringing up interest rates, Sasha, can have a real damping market effect on the overall position of the market, including my pipeline stocks, even though technically it shouldn't affect it.
Well,
it will.
Yeah.
It will. When interest rates go up, then the value of your dividend goes down, because let's imagine I could get a bond, for a treasury bond for 10%, then why would I want to be a risk in a pipeline?
Yeah, so if it went up that high, you're right about that.
I know that.
I don't think we're looking at that.
Right.
Oddly, the pipelines correlate very highly with oil, which makes no sense at all.
Which makes no sense, right? But
very little. I mean, they're affected very gradually.
I'm anticipating we're going to see a market decline, so I'm waiting to buy. That's the reason you go to cash, is you wait to buy when everybody else runs away. Interesting, though, Warren Buffett made a statement. He said monkeys are better at investing than financial advisors. Did you see that?
Yeah, I saw that.
Okay, and with all due respect, okay, to Warren, he's partially correct. Okay, most financial advisors are not investors. What they do is they gather assets. In other words, they sell to a platform that holds the assets, but they themselves do none of the investing. Platforms would be like SEI, which is a very major platform, DFA, another major platform. So the money management is actually done by some third party, and your financial advisor you meet doesn't do any of the investing today. I mean, it's a different world.
There's got people basically who talk to.
Yeah, right. They talk to the people. Well, actually, the ones I've worked with, the CFAs, they don't like to talk to people. In other words, they don't want to. Literally, I work with investment people. The ones who actually have custody and are doing the trades will not talk to the client, Sasha. Okay.
Yes, agreed.
What happens is that they will occasionally talk to the financial advisor who talks to the client, but the CFA themselves do not talk to clients. So getting to the people that actually are doing the trades, they're working it, is actually very difficult. So when Warren Buffett made his statement, it depends on what type of financial advisor. There's 88,000 certified financial planners. Most of them don't trade the market, Sasha. We broadcast on, but I know, and I've worked with these people for 38 years now, so I kind of know that they're not the market.
You know, in music, there is a very, very popular saying: is those who can play, those who
Sure.
can't teach. So
Sure.
it's the same thing as this.
Yeah.
So
I have an
people
interesting
can't
point about
pray,
Buffett,
those
but
who can't advise.
here's an interesting thing about Buffett that a lot of people don't realize, but if you look at his investment portfolio, not his deals, because he makes great deals. Like he'll
Right.
buy a company,
Sure.
he'll
Yeah.
get on the board, he'll be an activist, he'll turn things around. But if over large periods of time, his investment portfolio has underperformed the indexes.
You're
Now, he
talking
has
about
people
Berkshire
working
Hathaway.
for him,
Right.
but
Berkshire.
but his stock picks, now you
Right.
could also argue, by the way, I just held on to Coca-Cola or whatever it is because they didn't want to
What?
pay the capital gains. But he could have been in an index, in a lot of periods. Last time I looked, a long period of time, and his stock pickers himself, he could have been in an index. So,
Yeah.
but he's right. There's, a lot. You have a salesperson who helps you create a financial plan. But
Right.
picking stocks is tough. It takes. I spend sometimes 40 hours in a week just to find one.
Yeah, well, that's what I'm saying. The people like you, Peter, actually, people that the the retail clients aren't allowed to talk to, the people who actually do the work. So the thing is, it's kind of an interesting environment. So when he made that statement, I'm going like, who's he making this statement about? Is he making it about the financial advisor or the person who's actually doing the trade? Now, the other thing is a lot of it's hype and sales. Look at ARK. Who's that? Kathy, what's her name?
Yeah, Kathy Wood. Yeah.
Yeah, and her ARK. Now she moved to St. Petersburg, Florida. She was in San Francisco, and took all her tech companies that went down the toilet this year with her. Okay, so now they're headquartering out of the St. Petersburg area. But I've seen this time and time again on the quote stock gurus. They have a good year, like she did.
Right, and then they have a bad year. Yeah,
Yeah,
she's
but
down.
she's
She's
fine.
down like. Here's two
Yeah.
interesting things I saw about her this week. One is she's down over 40% this year. Just this year, she's had some terrible calls.
Right.
I could name them, but I won't get into it because I don't remember all of them. But she's done terribly with tech, even maybe worse than tech. But the other side is there have been more inflows of funds into her fund. She's down 40%, but people are still pouring money into her fund.
There are no
Because I guess
redemption.
they believe in her. She tells a good story.
It's marketing. It's the story. I mean,
Right, it's the
the thing
story,
is,
exactly.
a lot of people don't know that the reason they went to see Kathy's ARK, as the ARK is now sinking, is because they heard about it.
That's funny.
Okay, seriously, they heard about it a year ago. Oh, it's gotten too good.
Right,
So now
it
I'm
had the
gonna
best
get it.
performance in the
Had the best
year.
performance
Woo!
of the year, right? And I know a lot of these money managers personally, and they tell me there's one guy literally I've worked with that manages close to $1 trillion. All right, but he says I had one good year, and that just brought all the money in, and it
Wow.
kind of made me. In other words, all I had to do this 1 year. Now this is back in the '60s though, so it took him a long time before he has that 1 trillion under management, but he actually and his group does the trades. And I knew some of the people that did the trades. They were chess players that weren't allowed to talk to people. They never talked about.
Okay.
He was the face, but they didn't talk to people. So when he made that statement, I think there's a lot of truth. And he did have at one time a contest. He said, "I will give you $5 million if you can beat the S&P 500 in 5 years." And he had some takers. Nobody got the 5 million. They all lost.
Wow.
So, by the way, that's pretty impressive. In other words, what he's saying is that we could have that contest here to Sasha. We'll give any of these guys who think they're really good at investing $5 million if they can beat the S&P 500.
Yeah, don't put that in writing, Nick.
No, I'm not going to put it in writing because if you get too many people, there'll be one guy who might.
Yeah,
get
somebody will
lucky
get
and they're
lucky. Exactly.
Yeah, right. It's like picking. Well, you can actually insure it. It's like picking the, no one can pick the brackets of the basketball
Right,
game.
but right, exactly. And then you never know, one team comes
Yeah,
out of
but
nowhere.
it's a
somebody gets lucky.
powerful statement. What he basically says is you can't beat the S&P 500. Why are you spending all this money
Well,
on
Buffett's
money
right.
managers?
For most people, you know what? But you don't want to only have money in the S&P 500 either. You got to
Sure.
be diversified. I mean, you could have a bond fund, you could have just bonds, but for your stock market allocation, it's not a bad strategy. I've thought about getting back in the S&P 500 just in an index fund too, and I have used index funds. Right now I'm in I think it's XPI, the Consumer Staples Fund.
Right.
I don't want to own 50 different consumer staples with 6% of my portfolio, not even 2% of my portfolio, because I'm not even confident in consumer staples right now.
Yeah.
But they have their purposes. And the S&P, look, if the market drops a lot, maybe it'll be time. But so that gets into the long run. First of all, I wanted to discuss this and it's sort of indirect on my dividend pick, because this week I took a lot of my cash, and it may have been a mistake, but it could never be a mistake, because you can never lose on fixed income if it's safe. And so I had last week been buying muni bonds, full state muni bonds in states I trust, at about 2.7, 2.8% yield to maturity, 7 years. And this week I took a bunch of my cash and my IRAs, and because I had a lot of cash, which has been a good thing, and the energy's been great, obviously, the MLPs. But I took it and I bought basically treasuries, 30-year treasuries, roughly, yielding a little over 3%. And my thinking, first of all, I think I could easily be wrong in the next 6 months, because I think rates could go much higher. But the problem is they could also go much lower, because if at some point we're going to probably hit a big recession. As a matter of fact, somebody made a brilliant point, which was, they said, if the Fed raises rates aggressively, we're going to hit a recession. And if they don't, inflation is going to cause a recession, because consumers cannot afford this, and they're going to have to cut back if they don't control inflation, even if it's running at 5%, which I wouldn't be surprised if it is next year. At some point, people are like, okay, I've got to cut back on restaurants. I've got to cut back on discretionary. I've got to cut back on travel. I can't keep spending money I don't have. Credit card debt is soaring right now, and people cannot maintain this forever. So either the Fed is aggressive or not. But my theory is they're not going to want to be too aggressive. And so maybe they'll raise the rates to 275 or 3 or a little higher, but you get a flattening yield curve where the 30-year just stays at 3.
Mhm.
But my long range forecast is for a lot of problems as the boomers are retiring, people spending down their money. And so what I did is I put in a good percentage of my cash, maybe 8% this week of my portfolio into these bonds. But you know what? A lot of it's in my Roth. I get 3% for life, in 30 years. So, but who knows if it's a good investment or not? The short run.
You know what I saw, Peter, when I was doing studies for our pension company, okay, because we had to compare our fixed equity index annuities versus the S&P 500. Here's the conclusion. On any 10-year period, it depends when you started investing and then when you got out. And so, like, if you're started in year 2000, you got out 2010, our fixed equity index annuities beat the S&P 500. But if you move it up a couple of years, it's 2005 to 2015, you lose against the S&P 500. So even though people say timing the market, you can't do it, the fact is, if you can, you're going to beat the S&P 500.
Right.
But
the part
how do you determine the timing?
Right. It's impossible. I think the Fed may have to raise a lot. So maybe 30-year will go up a lot, but maybe it won't. And you know what? It was too tempting. I'll tell you why too, because last year I'm looking at, I had locked in munis at higher rates, but now it's like last year I'm shopping, I have some cash or some things are coming due. And all of a sudden it's like, I can't get 2% in a muni. I'm like, okay, I get 1.5% in a quality muni or 1.7. It's like, now all of a sudden I'm getting 3%. And it's like that, I can never lose that money. And I might not make as much as I could, but in the end I get it back.
But if inflation is 8%, you're really running down the toilet. over
Right.
30 years.
Right.
So
Well, but I read
you have inflation risk.
right, except for one thing. What if inflation's running 8% and there's no place to make 8% except for maybe the pipelines? But
The
other than
pipeline.
that,
I mean,
well,
yeah.
that's why I have 30% in the pipelines. But other than that, I'm just saying 3% may look good if everybody else is losing money, and maybe we get deflation, which is what I forecast in the future.
I believe Mr. Michael, no, it was who Mark Cuban actually did that when he made that big kill when he sold his company to Yahoo. He took half his money and put it in treasuries and then played with the rest. So if you have a certain amount allocated, it gives you that security. And when we work with our pension clients, we tell them, look, the pension money is going to earn, let's say, 1 to 5% or 2 to 5%. That's all it's going to do every year. But because you know it's guaranteed by the state guarantee funds and the insurance company, that gives you the ability to play with your other money in the market. In other words, take some risk in your 401k or profit.
Exactly.
Because you always have your bond account, you have your guarantee. And see, that's the way that you kind of have to play the game.
That's
now,
exactly right.
What I look when I'm playing the stock game, it's pretty simple. I like to buy low, sell high. Looking at the 52-week high low. It's really stupid, but it really works. In other words, if you buy something, it's down low. And then I got out of Walgreens boots a lot. I always look to say afterwards, should I have gotten out too soon or not? So I bought WBA and like went up like 20 or some percent. I finally got out of Walgreens stock. I haven't got back in, but I made a bundle because I bought low, sold high. I will buy into MPLX. I'm like Sasha, once it goes below 30. So I'm sitting here waiting like a little cat. Once it goes 30, I'm going to buy it because I think MPLX is a great hold because of the dividend, but I'm just waiting for that opportunity when it goes down. I bought USAC and I put some more money in Antero the minute it went below 10. Now it's way above 10. So I think it's kind of a simple strategy, but if you buy low, sell high, it's hard to lose. Even though
I would ask you though, right now the markets, there might be a lot of lows coming up. I'm not sure.
I know that's what I'm waiting for.
You know what?
To wait for that.
To me, it's energy and everything else right now, almost, and pipelines and everything else.
Well, and energy is a secure sector to be in.
Well, yeah, because I think we're in a transition period with decarbonization, and people are. One of the articles I read said something really interesting. They said people are realizing now that this I'm going to use the word dream of, okay, we're all going to be like on EVs tomorrow, and we're going to get rid of carbon tomorrow, isn't going to happen the way they expect, because there's reality, and the technology has to improve. But also, I'd add, as a footnote, the approach of the Biden administration has been terrible, because they should be working with the energy companies to get carbon decarbonization, carbon sequestration, things like that. There are technologies being developed, and the energy companies are already starting to clean up their act. As a matter of fact, in Canada, I was reading that Suncor and some of these other companies they're having a debate with the government about how fast they can do it. But they're saying, okay, we'll get rid of a third by this amount. But they have plans to ultimately get rid of it. But it's also going to drive energy prices through the roof. And there's always going to be the demand for energy. So that's why it's energy driving inflation.
Yeah, but you also have to be careful. BP just took a big 20% write down because they had a lot of investments in Russia. And I stayed away from the retail. The pipelines have a risk, because I keep thinking 10%, you could be a nuts not to buy something that's 10% if it's guaranteed, et cetera. But it has a risk. What's the risk of the pipelines? The Democrats say, the pipelines are going to destroy the ecology. Let's shut them down. That is a risk.
They can't do that.
Well, they're not going to do it.
If they shut them, I was concerned earlier
but that is a risk.
LNG, my only concern with the pipelines, first of all, if they shut down the pipelines, you can't heat your house and you can't drive your car.
I'm willing to take that risk.
And the only other way to, there's no risk of that. And also, if they shut down the pipelines, then it has to be moved by truck, all this energy, which is not expensive and creates more pollution.
Look what they did to Keystone. They shut down Keystone.
Well, yeah, but it wasn't built, so it was an easy thing to say, okay, well, that's what they've been doing for years. They've been shutting down the future expansions, and they've slowed down the growth of the pipelines. But the ones that are in place become even more valuable if they shut them down, because then it's like, well, this is the only way we can move energy. But so my only concern before, with the Biden administration come in, was whether they would shut down LNG, because we're not going to, because energy is so expensive, we're not going to ship LNG out, or we're going to. So, and they even did try to do some efforts to slow down the exports of LNG. Okay, we're going to say, or proposals, we're going to stop new plants for LNG. There's a lot being built, by the way. But now, this Ukraine thing, Europe, the whole thing has shifted totally because the world needs our energy now. Europe needs our energy. Europe just said they're going to try to get off Russian oil by the end of the year. I don't think they're going to be able to totally get off it, but I could be wrong. But either way, there's no more excess energy. There's not that much extra energy around the world. So they're going to be desperate for LNG from the U.S. Because that's how the only way we can ship them energy. They're putting in new pipelines. There's one from Norway, I think, but they need a ton of energy. It's a whole continent. It's like, and where are they going to get the 3 billion of oil? So this is why energy could go to $200 a barrel. Some people have been forecasting that.
However, in the real world, Peter, India is making deals with Russia that is buying 30% discounts. They're paying $70 per barrel. Okay. Yeah. So there are deals galore. There's a lot of tankers of oil, full of oil, and they're in the ocean because
but $70 a barrel, Russia's not making any money. This is Russia's problem because now if China and India are their only or main buyers, they could say, well, we'll pay you $70 or we'll pay you nothing. And they'll say, okay, we just need to keep our production open. So we'll
they can stop.
So they're basically they're probably paying cost. They're paying cost.
Because the oil and gas production cannot be stopped. It has to every day generate barrels of oil and so many.
Exactly. Otherwise, so the Russians are selling it at a loss or at a break even just to keep the industry out. Otherwise, they let their people go. They let their equipment go. This is what happened in Venezuela when they shut it down. It's very hard to rebuild. But the world does not have that.
About 2 years ago, remember there was a situation that oil had a negative price. There were so much oil. There were so many tankers at sea. There were no terminals available to take all this oil. So it went to negative.
Right. Can you imagine? You know what? The oil companies spent too much money on CapEx, but they're not doing that again. I don't think they'll ever do it again, probably.
Yeah, probably they shouldn't. They shouldn't. But
why would they? Why would they spend so much on CapEx and then lose a lot of money because, we built our industry up too much. So now they're being very cautious. And even if they were a little less cautious, there's such a demand now. And Russia just adds to it. And, and the Russian industry, I don't think a lot of people are going to deal with Russia, even if they were to solve this for next decades, unless they maybe got a new president, premier. But, so the oil situation is probably not changing, and it could go to 200 barrel. And then what does the Fed do? Again, they can't control energy prices. So, but there's going to, I've been saying for a long time, they're between a rock and a hard place because the Fed, also heading into an election year now. So they don't want to tank the economy before the election. That wouldn't be popular with the government. But, what are they going to do? They have to control inflation. So it's an ugly market out there unless you're in defensive dividend stocks, as we've recommended every week. My muni bonds, in a worst case, I get 3% for the next 30 years on that portion of the portfolio. I can never lose money unless I sell the bonds. So,
I'm very impressed with my selection of dividend stocks. The only one stock that, but I can dispose it because it's paying monthly dividends is Gabelli Dividend and Income Fund, GDV.
Oh, yeah.
It went down with the market, quite obvious, but it's still hanging there. It's getting now back to where it was a few months ago. But monthly dividends, you can dispose it. So I think, and the other dividend stocks all went higher and continue to pay dividends. And I'm expecting that they will either raise dividends or buy back their shares.
Yeah, the dividend stocks have been tremendous. What? Between my energy stocks and my dividend stocks, I would be actually up. The only reason I'm down is tech hurt me a bit. I made a lot of money on tech options for a while, but now this last year, I'm shocked at how low it is. But this scares me about the market too. That's my last point I wanted to make. If Amazon could be at 2,600 and then move to 2,400 and maybe go a lot lower, when the analysts are saying 3,500, and a lot of them were saying 4,500. If a company could have, good sales, good cash flow, admittedly a bad quarter or two, but only on the books, it's really, if you look at deeper, it's really a solid company, and yet it's going lower and lower. So if other than with a dividend stock, okay, as long as my dividend's paid, I don't care that much what the price is. If it goes down, I can buy a little more maybe, and it has the support. But if those companies can go down, there could be some major compression in companies I wouldn't touch in a million years. And there's a lot of them.
Well, as I said always in my programs, I always believe that the market knows everything. The market absorbs all the news. Market is always right. You cannot fight the market. You can just join. Maybe go into index funds, S&P 500 or so on. So there is always tomorrow on the market, and next week, and next month, and even next year. Okay, so with this, I would like to thank you very much, you, Peter, and Nick, for today's program. And we will see you next week. Have a profitable and healthy week of trading.
You too, sir.
Bye-bye, everybody.
Bye-bye.
Thank you, Peter.